Good morning, everybody. This is Kathy with Premier Marketing. Thank you for joining us. I have with me today Dana Brown from Protective Life. Good morning, Dana. How are you?
Good morning. Happy Tuesday.
Yeah, happy Tuesday back. Looks like we got a few more people coming aboard real quick here, so give them a few seconds to get going. But Dana's going to talk with us today about their Index Choice Universal Life product, which has actually been something we've been looking at a little bit more. A couple of good niches on their product. You can add a living benefit option for your clients so they can use 100% of the death benefit for long-term care if they need, which is something a lot of people have been talking about lately. So hopefully this hits home with everybody out there. If this is some of your clients that you're already talking to, let us know. I mean, go ahead and type in the question area. Yes, this is something that you need more help with. That'd be great for us. But Dana, I'm going to let you take it away and tell us a little bit about the product, how this works, and how to position this, please.
All right. Well, first of all, thank you for your time today. The Index Choice has been around for several years, and we'll talk about that in a minute. Just a brief talk about how we design our products, okay? 2 seconds, I promise. Just talking about how we develop products, what we look for when we're developing them. So we're in it for the long haul. If you've been with Protective for any period of time, you'll notice our products aren't changing and the names aren't changing frequently. You'll see versions out there of the same product. So when we make decisions on the products that we're going to offer and sell, you're going to see them out for years and years and years, okay? You might see some variations, like if we have to do anything from what's mandated by laws, things like that. But you'll notice, like the Index Choice, for instance, if you've ever quoted Protective and permanent products, the Index Choice has been around forever. So we've been in existence, Protective, for many, many years, over 100 years. I think we're at like 118 for years as far as that's concerned. So we've been around a long time. We were originally under the West Coast Life label, the Brokerage General Agency channel. So if you ever heard of West Coast Life, we purchased them back, I want to say it was 1988. So just a couple things about that. We want to do the right thing when we're developing products for our consumers. We want them very transparent, easy to use. And as we talk about the Index Choice, you'll see that it's really a simple design when we're looking at it, okay? So a couple of things. Lapse protection, first and foremost, when you think of Protective, lapse protection is something that we do very well. Now, back in, I think it was July of last year, we went and retooled the product, partly because we were making some changes to our portfolio in general. So the Index Choice used to have a lapse protection all the way to 121. That has actually changed. It's going to be consistent with what you're seeing out in the marketplace right now, where the lapse protection guarantee goes to 90 and the current can go all the way out to 121. It is flexible premium design. We're very competitive, which we'll talk about in a minute in what space. One of the things that kind of sets us apart with other carriers is our lower policy expenses, and our illustrated rates are around the same as the competitors, but if you see a higher interest rate, a lot of times you're going to find higher policy expenses within the policy. And so just know that that's the design of the product. So talking about the very simple design, it is based off one index. That's the S&P 500. We don't use any other index, just that. We have a 0% floor, which we'll talk about it in a minute, which basically means once we go through it, that 0%, you can't get a negative return off the S&P. It might hit a 0 in a particular segment, but you can't go below a 0. And then, of course, access to cash value for future expenses or unexpected costs, which in Extend Care, talking about that, there's some things that you can do a lot more with when you're using the Index Choice. So very straightforward, death benefit protection to 90, the S&P 500, annual point-to-point. We do have, as far as selling the product, we do have 2-year rolling targets on this product. We do have decent cash value accumulation. One thing that's not going to show up on these slides too is that when we made our change last July, we now have an option 2 or an option B benefit. So that's an increased death benefit that you can do. And when we talk about extend care, if I don't forget, we'll talk about how that could benefit you when you do an option 2, okay? So 8% cap rate, that's the max you can make on the S&P 500 within this product. The max illustrated rate is 5.21 and 100% participation rate is how it works for us. All right, so let's talk about segments for a second. And because this comes up a lot, I want to kind of address this a little bit. And one thing I just noticed on this slide, this is actually, it is 8%. Yeah, it's not 9%, I'm sorry. So I just noticed, I thought I corrected it, but it is not. Okay, so when we talk about segments, so when our product, we go and put, say they're paying a monthly premium, we will go, there's 12 segments in a year. Every month, their policy premium would go into an index segment, the 15th of the month. Okay, so when that happens, each segment will come due the 14th of that next year. It won't be the 15th because it's 364 days, and it'll credit based off that full year. So when you're thinking about monthly premium, it kind of diversifies the risk a little bit when you're going and spreading out that. But also I want you to think about for a minute, doing that with your 1035, or if you have a large lump sum, with the market volatility right now and not knowing how things will go with the market, by going and spreading into the different segments, it might spread the risk a little bit more, especially if it's a large lump sum. We don't require you to do that, but that might be something to think about. And you can see here how these segments work. So like I said before, it's a 0% floor. So if you notice on the S&P 500 at the bottom here, there's a negative 8% and a negative 12%. Well, the good news is the client won't get any credit. They'll have a 0%. So they won't hit that negative market rate that they got off the S&P. It's just going to be a 0, okay? So when we go and do a monthly payment or a quarterly payment, you're spreading that risk out into the different segments, which I would say right now would probably be advisable. So anyway, just some thoughts on that. That's how it works when you're going and funding these policies. They sweep into a segment on the 15th of the month. Anything outside of that and you paid it on an alternate design, it would be in the guarantee section until it sweeps into the index. Now, you can also choose for the index, if you said, you know what, I don't want to put 100% in the index, I want to do 50% in the fixed and 50% in the index, you can certainly do that. You can illustrate that way. That's perfectly fine. What do I mostly see? Most people are putting it in the index. Neither is wrong, but that's what I'm seeing. Okay, so our fixed account, that will show up in every illustration as well. It's a 3.25 current crediting rate. That's going to be your middle column. And a 1% guaranteed minimum rate, that will be your first column on an illustration. Okay, that's how it works for protective. So selling the 0, all this is basically saying when you look under the hood, under these types of policies, selling the 0 basically is if you look at that first column, you'll see a 0%, and you can see how well it's going to perform, because no matter what happens, that 0% is the max policy charges and everything within that contract, and that's really going to be telling of how long that policy is going to last at a 0% floor. So when we talk about that, if you've got the client that is just not comfortable with VUL sales and they're really looking at wanting to invest but not invest in the market per se, this is probably the best option for you, because it's not as expensive as a VUL, but you're also not hitting those losses that a VUL could potentially do. You wouldn't have to worry about recovery from them. Also, it appeals to those clients that want to be in a guaranteed contract, but they want some upside cash value available for them. And we'll talk about, I'm going to slip past the competitive positioning for a second. Riders and endorsements. So going to the Extend Care rider, this is one of my favorite riders. It's probably one of our most popular. This is a chronic illness accelerated death benefit rider, okay? You're going to notice here it's going to act a lot like a long-term care to trigger a long-term care policy. Severe cognitive impairment, can't perform 2 of 6 ADLs, activities of daily living. The difference is this, it's an indemnity payment method. So basically what that means is they don't have to submit receipts. When they go on claim, it will trigger the rider. There's a 90-day waiting period. And then they can take dollar for dollar off their death benefit for these chronic illness expenses, okay? So after the 25th month, though, those policy expenses are permanently waived within the contract. So here's where a lot of people ask me, can you go on and off a claim? The answer is yes, but I don't often see that. Normally, people, when they go on claim for the Extend Care rider, they really don't want to go through the hassle or the effort for something short term. They typically do it for like long-term situations, Alzheimer's, Parkinson's, that kind of thing. Have I seen them go it for short term? Yeah, I've seen it, but not as much. So what it can do is it can go off you choose a monthly amount. It can't be, so one of the things with this particular rider, it's not filed like a long-term care rider. So it's really treated as a acceleration of death benefit. A 101G filing is what we call this particular rider. All the long-term care riders that are true long-term care riders, those are 7702 riders, okay? Different filings, so they operate differently. So what you do is when you go and illustrate this policy, you're going to add Extend Care, and you can choose the monthly amount, the max monthly amount, because there is a charge for this rider that you want to choose. And when it triggers, you can choose the full amount, or you can say, I want to use the minimum amount of $3,000 right now, and then next year, because it's 12 months, you basically requalify for this rider. Now, one thing about that rider, it's a 2-page claim form. It basically says, the doctor has to sign off, says, hey, they can't perform 2 of 6 ADLs still. It's the same way they have to do it for long-term care. But a 2-page claim form, they fill it out, and they continue on if they've already triggered the rider. You can use up to 5% or choose the max amount this year because is 11.7 for the per diem. Actually, in all the years that we've had this rider, this was the first year that the per diem amount went down. Like last year, it was 12,000. It's now down to 11.7. I'll be honest, I've never seen it reduce. This was the first year that it did that. So one thing we don't have on this rider is we don't have an inflation rider. So it really is best to try to choose the max amount that you think when they go on claim that they will need for monthly expenses. Now, like I said, there is a cost involved. So it's not that bad. You can run an illustration. The index choice, actually, the way you structure it, because of the design of the product, you really do have the availability of tailor fitting. Like if you need Extend Care and you need to go and basically you have a certain amount of money or a lump sum 1035 that's coming over, and you want to structure it so you've got as much Extend Care or death benefit as possible for a certain length of time, then you can do that. All right, so this situation, we'll go back, and I want to pull something up in just a minute, but I don't want to switch. So how could you afford the Extend Care rider? So I'm going to talk about another rider that's also available with Protective, and that is called the Income Provider Option Rider. I'm only bringing that up today is because this rider might allow you to be able to add Extend Care on here, okay? So this is just a hypothetical situation where we've got a 70-year-old. She had a municipal bond for $400,000. It basically is equating to $16,000 that she's gonna get. And what we're gonna do is we're gonna basically take that and put that into a policy in just a second. The situation is she's got a married son, 2 grandkids, and 86-year-old, age 86 at death is what they've illustrated. So what they did was they took that $16,000 that they got from that municipal bond and they put it in the index choice. It basically generated a death benefit of $547,820 with that. So the life insurance was $547,820. The muni bond was $400,000. So just a way you can do that and stretch the legacy. So talking about that, because it's broken down, is with the income provider option, it's treated like a paycheck, okay? So it basically pays the death benefit out in a death benefit structure, okay? So we call it poor man's trust. We use a lot of different things, but you can structure basically a death benefit to be paid out partially in a lump sum and then do annual payments out to the spouse or to the daughter-in-law, however you want to do it in this situation. So that $16,000 premium that they got from the muni bond basically bought them a $547,820 death benefit, but they were able to increase the legacy to $584,440 from that by using the IPO. So what they did was they structured the death benefit for 20 years with a 15-year payout. $20,000 for a 15-year payout, and then did a lump sum of $284,480. So think about this for a second. So here we're trying to increase a legacy, but you can also do the same thing with Extend Care. You can actually go and add Extend Care on here, and it can control the amount of premium that you need. So in this situation, we have a designated point of premium that we're putting in. We can do that same thing and just add Extend Care. All right, so, and I'll go back to that other stuff. Couple of things to think about too. If you have currently a custom choice, classic choice, old secured T products, you can also convert. So if you've got a policy right now with Protective that's any of these term policies and they fit within the 5 years for the classic choice or 20 years for the custom choice, you can move to this index choice product as a conversion option. So first of all, we know that that people are looking for lapse protection right now. The IUL with Protective is got some great cash value you can generate. It's got the Extend Care option on it, which we'll look at one more thing. And then also you can clearly see how it's going to protect the customer. Straightforward design, the S&P 500 it's very simple. I've been using this product for years, and I will say I don't get a lot of questions with it. The most questions I get more than anything is understanding the segments. Is probably the biggest thing that I get. It is a lower expense product. You can run an alternate rate. I would encourage you to do that if you're competing against any other carrier, is to run us at 5% across the board. And that is kind of telling because it'll go and kind of look under the hood and see how those expenses are impacting the policy. Just talking about our suite of products is the Classic, Custom, Advantage. You'll notice they all say that. Those are our lapse protection suite, except for the Strategic Objectives. That is our VUL, if you sell VUL. I don't believe you guys actually will. So before I do that, I'm going to flip open this slide real quick. Bear with me. I'm going to switch. And I just wanted to show this one for you. And this is talking about our chronic illness. I'm going to drag this over here because I didn't add it to the slide. Okay, so this is a good situation where talking about a sales idea of how you can get what you want, help and get that Extend Care on there for chronic illness. One thing I forgot to mention too for you is that don't forget this. With long-term care, and I'm experiencing this with my mom right now, is you've noticed a lot of long-term carriers have gone up in their pricing. My mom got one back, it's probably been 20 years now. And she got it through a different competitor. This is actually before I worked for life insurance many years ago. And she got this long-term care policy. Well, what I'm finding over the years is that her premium keeps increasing. Well, with this product and why it's so important for it to be on a permanent universal life product is the fact that you're not worried about anything, the cost of the long-term care policy or the chronic illness going up. You're controlled by the death benefit. You're already paying the premium, and that's all locked into this policy. So that's why it comes dollar for dollar off the death benefit when you go on claim. That's why this is so critical. This will control the expenses for the consumer, okay? So in this situation, what we've got is an annual premium across the board. $27,784 was the premium. I think this lady, or no, it was a male 55 for $2 million. I was going to say that seems a little high, but for $2 million, and they did a cash value solve. Now, if you're trying to lower the premium as much as possible, $1 at 121 is probably the best way to get that, okay? At this point, it was a 5.17 illustrated rate. We're actually higher than that right now. We're sitting at a 5.21. But anyway, what they did was they kept the premium the same, and all they did was say, okay, if I added extend care for the max, now you'll see on this one it says 12,000. The max this year is 11.7. This was done just prior to us having to adjust. We were controlled by the per diem by the government. So when we do that, you'll notice that the original one without extend care, it was guaranteed to 88. By just adding the 12,000 or a month on this one, which 11.7 is the max we can do this year, we can actually, it only shaves off a year of guarantee. Now, this still continues to 121. It just only goes on the guaranteed side to 87. So that just tells you what a minimal impact that is. And then, it's not paying any different in premium. It's just the guarantee was shaved off 1 year. So that's one thing I want to say to that. You don't have, of course, talking about reimbursement. We don't have to do any of that. It's an indemnity. So I want to tell you this. With the extended care rider, if for some reason you have a loved one that can take care of you instead of you going to a facility, say you're not in the place of going to a facility, but you just need help and you can't perform the 206 ADLs and you need somebody to mow your lawn, get your groceries, anything like that, we cut you a check. You do what you need for it. I mean, if you need it for somebody to help you and aid in cleaning up your home or anything like that, you can do that with this money. We don't ask for receipts on that. That has nothing to do with it for us. Now, if you want to go and say, you know what, I only want a certain amount for extend care and then I want to shut it off, you can do that. Now, you can, at the same token, you can accelerate 100% of the death benefit for long-term care expenses. You can certainly do that. But if you want to stop it and say, I want to keep $25,000 for whatever for my beneficiary, we can do that as well. You have that control. All right. Let me just see if there's anything else I want to tell you about that. I think that's about it. I'm going to take the time now and ask any or leave it open for questions, Kathy. If you can just see if you see anything in the chat so that I can address them if anything comes up.
Yep, I do have one question so far. So if anybody else has additional questions, go ahead and place it in the chat and we'll ask it here. I have a prospective client with a term product who asked me to help her, sorry, I can barely read this, with a permanent product. She has chronic health concerns too. Mm-hmm. So this to me, what you just went over here, would actually be maybe a very good, perfect fit for your client that's out there. That's the only thing I have so far. I do want to go back to your one question. This is something we do get asked quite a bit, but on and off claim. When the client goes on claim, does the client still have to make premium payments?
Okay, good question. We don't require it. And then but I'm going to tell you the middle ground. The whole,
Okay.
okay? The whole is this. There's no tricks to this. We don't require it. Now, so you'll notice in like the first couple of slides, I said that once we hit the 25th month, we're on permanent waiver. So if they go off a claim within that time period of, I'll say the first year up through the end of the second, if they haven't paid enough, so deductions continue within the contract until we get to that 25th month. So normally that's not a big deal. There's enough value in the contract to support that. The only time that could come up as an issue if you've only been in the contract for a very short amount of time, like a year or two, and it's fresh, which normally doesn't happen a lot. I would tell you, if you're planning on going on and off a claim, if you think it's something that's recoverable, I would tell you to pay the premiums. I would tell you to do that until you get to that 25th month if you think you're going to go off a claim. You know what I'm saying? It really is dependent, though, in the first couple years. But as far as protective, we do not require it. Most people don't require you to do it. We don't require you to do it, but do know charges do continue up till that 25th month.
Okay. And again, at the 25th month, go ahead and explain that again, how the waiver,
yep.
The premium waiver.
It's permanent waiver. So deductions don't continue within the contract, and we don't require premiums or anything. It just goes. So meaning if they wanted to continue on going forward and they're still going to operate the same way where they're going, exercising their payment monthly, coming off, I should say the check is going to them month after month. The only thing is they still are going, they're having I'm having a moment, claims. They have to go and do the 2-page claim form. Brain freeze, good Lord. They do have to continue doing the 2-page claim form. But yes, the deductions after they get to that 24th month stop within the contract.
Okay, perfect. We've got a lot of agents been calling and asking us for help with something with a chronic illness rider. I really think this is something we've been trying to look at and explain how easy this is for the agents to look, especially at younger ages now when people aren't thinking about an accident can happen or an illness can happen to younger clients. They could have a stroke at an early age, or you never know, cancer that puts them in a nursing home or needs care at an earlier age.
Well, and think of this, the younger they are, the more opportunity that they can afford extend care as well. Like the cost is so much lower for somebody young. And one thing I didn't say to you was we can write it up to table 4 for extend care. There are a couple of knockouts that is similar to long-term care where we won't write extend care on a contract. Those I can get, Kathy. So if it comes up as a question, I've got those. They're called medical disqualifiers. There's not a ton of them, but they run consistent with how long-term care does.
Wonderful. That'd be great. That way we have them for handouts if anyone asks on this. Does anyone else have any other questions? I don't see anything else popping up right away. But very, very good, Dana. Thank you for going over this. This has been amazing. It's always good to get a refresher for my team to review all this information, ask additional questions that we sometimes, we forget too. So appreciate all the help you've done in putting this together for us. If anyone's got any additional questions, please reach out to us at 800-365-8208. The team extension is 607. We're here to help you out. Everybody have a great day. Thanks, Dana, for all your help. Much appreciated. Have a great day.
All right, no problem. You too. Bye-bye.
Thanks. Bye. Thanks, everybody.